Bring it on.
Are you trying to raise capital during this pandemic? Our guest is an entrepreneur, an angel investor, and he is a Boston startup community favorite. And he's ready to tackle all your fundraising questions. Woohoo! Stay tuned for the Startup Life Show. Hello, everyone, and welcome to the Startup Life Show. I'm your host, Ande Lyons. I coach first-time founders, and I'm so delighted that you tuned in today. You see, after raising 4 businesses of my own, I now work with newly minted business owners, and I help them sleep through the night by giving them peace of mind because, hey, a new business does not come with instructions, not that I know of. I'm so thrilled that you carved out time to tune in and up your founder game while learning how to raise capital during a pandemic. And for those of you watching the replay, please like this video and be sure to click on that subscribe button. Thank you so much. I am just over the moon excited to introduce you to our guest, David Chang. David is an entrepreneur, and as I mentioned earlier, he is a favorite in our startup community. Look at all these companies that he has been involved with. He's held operating roles at 6 startups, 5 of which were acquired, and he's invested in 60 companies. Can you see them all there? Count them, 1, 2. And as a leader in the entrepreneurship community, David holds several advisor board memberships, and he was entrepreneur in residence at Harvard Business School and director of the Babson Venture Program. Oh my gosh, and he recently formed an angel group. Back in April, a bunch of angels got together. It's called TBD Angels. And you know, they've invested in 11 startups since then. I mean, come on, you can't let a pandemic hold you back. And the last time I got to see this wonderful man, David Chang, was at our monthly pitch event, Founders Live Boston. It was the last one we did live back in February 2020. Oh my gosh, there we are with other wonderful female founders from Boston. I am so excited to introduce you to this phenomenal person, David Chang. Welcome to the Startup Life Show. Woo!
Ande, thank you for having me. Your intro music just puts us in such a warm mood as I look out on the snow coming down on my street.
That's right, folks. It is snowing here in Boston. Oh my gosh, can you believe it? I'm just going to do a quick happy Halloween to all of you out there. I've got my decorations in the background here, so a big boo to all of you. David, you actually live in Boston, right?
Heart of Boston, yes.
In the heart of Boston. I live a little north, folks, in a town called Andover, which I love because it has an R at the end, so I can say Andover. And so where are you hailing from? Let us know. Pop your questions, your location into the comments. And also what I would really love for you to do is use this opportunity as a networking event. You know, we don't have anywhere to go right now in person. You still have to meet people and connect, and you never know where your next collaboration will be. So put your business name and website into the comment section. I will bring it up. David and I will do a woohoo for you when we do that. Okay, everyone? I just want to say hi to a few folks. Here's my co-host of Founders Live. Yes, he is a rock star, AJ. Did you see that photo I put up? The last time we had a live event, David was our expert. How about that? So good to see you, AJ. Hello, Prashant Sheth. So nice to see you and meet you. Thank you for swinging by and saying hello. So, David, speaking of scary times, Halloween, right? We know historically that during really tough times, amazing businesses come out of the mess, right?
That's right.
You know, we saw Airbnb come out of the economic downturn. I mean, nobody would have ever thought to raise, have somebody in their home and let people, strangers, into your cars for like Uber and Lyft. It's a great opportunity for industries to disrupt during what we're going through. So I want to go right into your startup investor operator origin story. When did you start working for these amazing companies? I mean, look at this lineup right here that you were participating in. How did that happen? Why didn't you stay at Goldman Sachs? Why didn't you go, the traditional route after getting your MBA at Harvard?
Yeah, I think of myself as an accidental entrepreneur, and I had gone to school at a time which was absolutely poorly timed. It was the height of the internet bubble, for those of you that are old enough to remember that. And when I was in school, the first year, everyone was trying to figure out, how do I do a startup? And we joked around in our business school classes that the class was over as soon as one of us figured out how to make $1 billion. We're like, great, so it's 10 minutes in, 20 minutes in, 30 minutes in. And then our second year of school in 2001, when I graduated, was absolutely opposite. Everyone was rushing back to stable jobs. And what I found was that in the 2 years I was there, I was a big company guy, but then ended up getting super lucky and found a cluster of people that were interested in doing things at smaller companies. And what the fascinating thing for me was the ability to just do more, right? At a smaller company, you wear all these different hats. And that was something that was so new to me. And that was the beginning of a journey that's really a lifelong journey.
Yeah. And I love that the most of what you just said, because for a lot of people when they're transitioning,
not all, right?
When they're transitioning from being an employee to part of a team and a startup team, and they have a hard time with that, wearing many hats. They're used to having their role being this. And I love that you embraced that, wearing many hats. Like, what are some of the things that you got to do that you hadn't done before?
Yeah. So many. So I was originally a geeky software engineer, and my first role coming out of school was at a little company in the middle of Natick, and at the time I thought it was pronounced Natick, right? And so I didn't know where I was. I'm a New York native. I've lost most of my accent, thankfully. But I ended up working at this company. It was maybe 100 and change people, maybe 110, 120. And so to me, that felt tiny. And the cool thing was that at a company that's pretty small, you get to do so much more. And I went from writing software to suddenly defining problems. And I got my hands slapped a bunch of times by really good engineers, where I kind of leaned back into trying to solve the problem. It's like, no, that's not your job. And you learn very quickly. And so did product management, then did product management for a B2C company, TripAdvisor. At the time, TripAdvisor was a tiny company as well. We were 35 people. I think I was actually the first dedicated product person. Like, they never had a product person that was because everyone was wearing all these different hats, and it was this luxury that, we could have someone just focus on product, and that was my role.
But the beauty of that too is you saw founders struggling with was Paul English part of that group? Is he one of the founders?
No, Steve Koffer and Langley Steiner were the founders of TripAdvisor.
Right. And so you got to see what they went through and learn as you watch them and see the struggles. Because look, founders, you got to know, if you've never been a founder before, there's really no preparing you for this journey. So what David got to see was how people think, how people be while they're going through this process. I love that for you. I'd love that for anybody out there to go work at a startup, to wear different hats, to be able to get a feel with how the journey is going without being completely responsible for the bottom line. Those founders were responsible for being out there and raising capital. But David, you got to watch them go through that journey and all the parts and pieces.
Very, very much so. So for those of you that are maybe thinking about, do I do my startup? Do I work at a big company? I think there are many paths, and you find the one that is right for you. And for me, it was working underneath some great founders to be able to just learn a ton and then start doing yourself. And so that was my start to it. And then I went from product to marketing to operations, and wore a bunch of other hats after those two first companies.
And it's what makes you such a great investor and such an outstanding mentor, because you know the landscape. You've been part of all the pieces that are required for understanding this. I talk about, before I earned my MBA, David, I went to Simmons, which at the time was an all-women's MBA program. It was great.
I bike by there all the time. Yeah.
Yeah. So I worked for founders of 50 to 100 people, and I was the founder's executive assistant, and I called it like my boot camp because I got to watch how they managed the departments, how they raised their capital, how they made it a profitable, sustainable company. I always said it gave me my boot camp training to be a founder. So before we dive into some more of the fundraising during a pandemic, during a crisis, there's something I always like to talk about, David, before, in any conversation with anybody. To me, this is the most important part and one of the most important steps of your business founders. And I know David, as a product guy, really loves this as well, which is prove that value prop. And, we can have the best ideas since sliced bread, but as we just learned with Quibi, who raised $1 billion and didn't have an MVP, just they were waiting to put it out. And then they raised another 750 million and they just closed their doors. They blew through a lot of money in 2 years. I think they skipped this stage, David. What do you think?
Yeah, absolutely. And you had opened up the show about some of the best businesses get created in times where resources are scarce, whether it's a recession or a pandemic. It forces you to really pay attention to what's creating value, right? Value prop is a great MBA term, but what does that actually mean? It's like creating something that like people need, right? At the end of the day. And if they need it, then they'll want to pay for it. And if you get paid for it, then you can do more of it. And so it's actually pretty simple.
It really is. And the Founder Institute, everybody has this wonderful, wonderful quickie right here, but it is a value prop. It's your one-liner, your company, your offering, your audience, the problem you're solving, and the way you solve it, your secret sauce. It's so important. I just wanted to touch on that because what I found, David, through co-hosting a monthly pitch event, and reading pitch deck after pitch deck in years, and of course of raising millions in VC and thousands in angel myself, having a succinct one-liner so everybody can get on the same page on that first slide. What is it you're doing, who you're doing it for, and what makes you unique is so important. So I want to throw that out very quickly to the founders. And again, before we dive into advice for founders raising capital during a difficult time, I'd love to have you share some information about your newly formed, the group of angels that got together and in April launched TBD Angels. Would you share just a little bit with everybody about it?
Yeah, the backdrop of that was a handful of us were doing angel investments one-off. And we discovered that with a group of other like-minded people, and it made a lot more sense just to share ideas, share workload. And so it was no more complicated than that we were just doing things really inefficiently. And so what started as a group lunch over pizza in February turned into an official thing where we launched, of all times, during a pandemic on April 1st. So April Fool's Day of all times. I don't know why we chose that now that I think about that, but we created this group. We had 24 angels. It was a nice mix of people in different industries. The 24, we had exactly half and half. So half the investing members were women, half were men. And we created this group mainly from a need that we had that wasn't met by other groups. And so we were primarily operators, and we wanted to change the process of angel investing a bit by making it more quick and real time and almost on demand. And so that was the thesis behind launching this group. And I guess if we were to think about doing it another time, it was maybe poorly timed, but at the same time, we've been finding great entrepreneurs and we've been attracting great angels. And so we're north of 80 members today.
Oh my gosh, in such a short period of time. So clearly the group resonates with folks. And it's really important. I remember an angel investor with my food manufacturing business, David. He wrote me a check for $20K, and that was the beginning of a long and fruitful relationship. It was wonderful.
Fantastic.
But it was sometimes honestly, founders, that 20K, it leveraged so much for me. It may as well have been $1 million. And as David said earlier, during these tough, lean times, you get so creative and you get so on purpose that you use your money wisely. You raise too much, you forget about the runway that you need to have.
Yeah. And especially, as you know, in the early days where a little goes a long way, right? And so you have this disproportionate impact when you're at the very beginnings of a startup.
And it feels so good. And founders, it feels good for the angels too, okay, that come into the business. They love helping you out. So when you're going out there and you're going to start these conversations with folks, remember, there's something in it for them too. It's just your job to show what's in it for them, because it's just such a lift to be able to give a founder just that little bit of more oxygen that they need to get going and growing. What's the typical size investment with TBD Angels?
Yeah, we've invested in 11 companies since since our launch. The typical check is anywhere between 50 and around 200K, and so kind of average size for an angel group. Our portfolio is industry agnostic, and so it's startups at the early stage, and we've done investments in MarTech and FinTech, one AI play. We've got a clean tech one as well, a couple digital health tech. And one really cool thing is also 5 of the 11 of our 11 first investments have been in women founder CEOs. And so I think this just kind of shows that when you attract a great diversity of investors, you get some great deal flow. And when you get great deal flow, you get to choose from lots of different kinds of founders. And so we're really excited about that.
And are the angels from all over the country, the world? Are they local?
Yeah, so we're not open to, or we're not closed to angels from all over the world, but we've found, because it's grown somewhat organically, that many of the angels are from the New England area. And so we have a couple out west and a few out in other places, but we've honestly actually have not been proactively attracting angels. And so it's been a little bit more of the, people we run into, and honestly, our founders that we meet, sometimes they, when we work with them, they're like, I have this great other angel that no one else knows, and they would be a great part of this group. And so those are some of our most positive referrals.
I love that. Something fierce for so many reasons. It's because when you have a nice diverse group with sort of a common theme, all operators, they're having conversations and they can bring an interesting deal to the plate that may not be a fit for them, but could be a fit for someone else in the group. So that's terrific. So let's dive in to advice founders need when they're trying to raise capital, especially during these times that are difficult. There's this high level of uncertainty. And you and I both know, founders, if you haven't gotten your MBA, there's a part of getting your MBA that they talk about, which are moments like this. And we don't hear this very often, David, do we? Where they say you've got to be prepared in business for when everything hits the fan. And there are things that you cannot expect, right, David, that are going to come out of the blue?
Yes. And absolutely. And you had mentioned just even MBAs, right? Like I hope folks know that is absolutely not a prerequisite. I think Ande are some maybe even a little unique in the sense that we happen to have them, but in startup land, founders come from all different types of places. And so make sure that people don't think that is a prerequisite.
Absolutely not.
Probably a downside.
Yeah, you might be, too caught up in certain parts. You are bringing your passion and your ability to execute and implement. That is what your ability is, and a degree is not going to be able to prove that to anybody. It's just, certainly it helped me as a woman back in '89 entering, and wanting to do more of what I wanted to do. The MBA helped me with my credibility. And of course, I learned how to work well with women. And just a sidebar, David, women at Simmons, it was founded by 2 PhD professors from Harvard Business School. And they saw that people got caught up in semantics a lot. And the men got more attention during the case studies and class participation. So they founded this in '74, the MBA program. But, women also have, in my generation, were raised to be individual performers. And so what Simmons did that was so interesting is that they gave us too much homework that we could ever do. And we had to count on the team to pull together and everybody take ownership of their part. And it was a great training ground. Nowadays, younger generations, they are in sports, they're doing so many things together. They understand how important it is to work as a team. But for getting, an MBA was a wonderful, wonderful experience. So let's first talk about how you're sitting there, you figured out how much money you need to raise, or you think you know how much money you're going to need. And now, wherever you've been in life, you don't know an angel from anything else. And you need to have that initial conversation to raise money. And who do you approach? Do you approach VCs? Do you approach angels? How do you go about, how do you start and have those conversations and find folks? This is a great slide that's from one of David's decks that he has taught, some things to start thinking about. And also understanding that it's the warm conversations that you need to begin having and socializing. So if you could talk a little bit about that, David.
Yeah, sure. I think there's probably two parts of that, right? So the first one is around knowing when you're ready and determining how much you want to raise and what are you going to use it for and what are the key milestones. And so before you even talk to anyone, make sure that you've got at least a sense of that. And I like to think of it as three different parts, right? There's some number that you're looking for. There's really clearly some use for it. And you can have a little spreadsheet that just tells you, what the key expenses are and revenues if you're going to have any in the early days. And then the one that people often get tripped up on is, what is the thing that they're producing? Like, what is that big milestone that they produce as a result of that? And 9 times out of 10, founders use that milestone as we are out of money at that point, right? And so Eric Paley, another local investor, great firm, Founder Collective, wrote an article a little while ago, and I think it's in that tiny footnote of that slide that you're showing. But I think he succinctly said it is like running out of money is not a milestone. And so if you think about it from an investor standpoint, they're largely trying to figure out, if you raise X dollars and you do something with those dollars, what is qualitatively different about your startup at the end of that process? And it could be now you've got a team. It could be that you have a little bit more sense of what the product is. It could be you get some early data points on market demand, right? So it could be a number of those things, but those are the things that de-risk the venture in investor speak. And then from entrepreneur or founder speak, those are the things that increase value, right? And so the very beginning, your idea is worthless. It's worth 0, right? But if you have a team, then it's worth something. If you've got a product, it's worth something. If you've got some demand, it's worth something. And so all of those things, before you go out and talk to people, have a clear sense of what you're trying to de-risk and what you're trying to prove as part of that. So that's the sort of point number 1.
Oh my gosh, I love that. Because founders, first of all, the milestone, running out of time is not a milestone. This is why, as scary as it is, you have to start thinking about raising money and really identifying what it is you need. I have a great list of investor questions and questions for investors. Ping me. It will be in the show notes for those of you watching the replay, so that you can be prepared. You can get more confidence. Talk to other founders, find out what they've done in order to make those introductions, to find their pathway, and then to talk it out. Mentorship matters, everyone. They're out there. Accelerator programs are out there to join to help you really understand. You got to keep that oxygen. You got to be really focused on bringing that oxygen into your business before you need it. And so I love also the de-risk. Now, of course, everything is a risk. There's absolutely 0 guarantee. It's the possibility, and it's the ability to, as I said earlier, to execute and implement. What are some things that you've seen founders do that you said, oh no, they have not de-risked at all? So what's an example of that, David?
Yeah, one that probably drives me a little insane is the founder that puts up a number of excuses as to why something can't be done because of some perceived scarce resource. And so maybe to make that super concrete is, I've got this great idea and I know people want it. All I need is, this first customer to, do a pilot or, whatever that example is. And so that common mistake is that they believe that this external obstacle is the sole obstacle that stands in their way. And the challenge and the problem with that is that if you get rid of that obstacle, there's another obstacle right after that. And so it's a little bit of the whole mindset of, oh, I can't create a product unless I get my first $100,000 of funding, and there's nothing else I could do. And so that's why we haven't started. Or I can't go sell because I don't have the right product to put in front of someone. And so as Andy, in startup land, those obstacles happen all the time. And so you've got to be able to figure out, well, how can I break that problem up into something small? And so that's probably the main one that I see with some first-time founders, and that is definitely a challenge, right? And so how to get them to think more iteratively.
That's right. You've got to think proactively. And for our female founders out there, there's still a bit of a bias toward you. So while the questions to either your male co-founder or to other male founders in the room may seem proactive, whereas the questions to you will be preventive. What are you doing to, you've got to be prepared for that. We can feel upset that that's the situation, but come prepared so that you're not coming up with excuses. You're showing how you think. You're showing that you are addressing those risks ahead of time. You may not have the answer yet, but every day that is something that you are focused on and ready to solve. Ain't nothing stopping you now. I feel that song coming in. It's so, so important along the way. Hello, I'm just going to bring up a quick question. Nope, I think a quick comment. Some very inspirational guys I know from the SBS Special Boat Service say that as soon as you start making excuses, you've already given up mentally. From our friend in the UK, Nikki Pasquier. Yes, Nikki. Boy, is that the truth. And it can just stop everything in the tracks. And you can't have that. That's why mindset hacks are so important as founders. I know I had a slide here for that soft introduction. I'm not sure. Let's see, is that it? Here it is. Let's talk a little bit about this because.
Oh, sure.
Yeah, it's a funnel, folks.
Yeah.
We are living in it. When you're raising money, there's no different in the funnel aspect as it is when you're selling and bringing sales into your business. You have to understand the sequence. You have to find your connections. You have to know what you're going to do. So go ahead, David, and chat a little bit about this slide.
Yeah, I do think this one particular one does answer your question of like, how do you approach folks? And fundraising is much like any other marketing campaign. So if any of you have either sales or marketing backgrounds, fundraising campaigns should look pretty familiar, right? There's a sequence of steps that you go through. And this middle one about socializing is perhaps the one that's a little different from others. And so when I think about a fundraise campaign, there are these 5 steps, right? The first one is just, prep, make sure you know what you're talking about. Number 2 is target, like figure out who you should be speaking to, right? Like, is it an angel? Is it a VC? And we can spend tons of time talking about like, what's a good fit? What's a bad fit? They invest in the space that you're in, where they're located. So there's a number of reasons why you want to get a good target list. And this third step is the slide that you have up, which is around this whole adage of, if you want advice, ask for money, and if you want money, ask for advice. And while that saying's a little trite, there's definitely psychology behind it. And so if you start approaching investors, one great way to build momentum is to socialize the idea and not actually ask for the funding. It's more around figuring out who are the likely candidates and find your strong connections, right? Because the stronger connections are definitely better than some of the cold ones. Right. Very frequently, you'll have to make cold introductions, and that's absolutely fine. But you want to do that for a period of time before you go out and actually make that hard ask.
That is so great. That's excellent advice. And, if you're watching and you live in Tennessee or Ohio, I get it. It's not like in the startup community here in Boston where we are, there's so many events. There's so many people who are just a handshake away. I understand. But find ways, find communities and groups that are active. I know, for example, in Cleveland, they've got great things happening. You can find your startup communities anywhere. And if you need to go out nationally, I always say hop on Twitter, follow the startup hashtags, follow the hashtags that are relevant for your business, find out people who have an appetite. There's so many great, and then of course, follow TBD Angels on Twitter and follow David on Twitter, see what he's, up to and what he's doing. It's a great way to start building that network and seeing if people have an appetite for your business. And that's, another thing, David, is the rejections are going to be high, just like in anything that you're selling. And so what advice do you have for founders who are seeing no, no, no every single time?
Yeah, I think the sequencing matters a lot. And one anecdote that I'll share with everyone is a couple years ago, actually probably more than a couple years at this point, we had the CTO and one of the founders of Pandora Radio come in, and he had shared with our team that he had spoken to over 300 potential investors before he got his first yes. So that's 300 plus no's, right? And so I think the number was actually 360, and 361 was where he got it. So you're fundraising for a year. Every single day you're talking to someone, you're getting no, and it comes right back again to the end of the year. And so, the takeaway is, was it a bad idea? No, that wasn't it. It's untargeted conversation. So you're going to get a lot of no's. And so the first one for founders is to do some of that homework up front to try to figure out who's likely a fit. Whether it's stage, whether it's space, whether it's thesis. There's a sequence also that builds upon itself. And the typical one in the early days is if you have, in industry terms, it's friends and family, there's angels, there's VCs, there's growth equity, that in the very beginning, they tend to be people that know you, and it's less about the idea. Of course, the idea matters, and the space matters, and execution matters above all else. But in the very beginning, your first supporters will likely have some sort of experience with you, whether it's truly just a friend or if it's a family member, or maybe that term should be more accurately described as like, people who know who you are and know you do just generally good stuff. And so it could be another colleague. It could be someone from college where you've, have seen you just execute on something. And so those are likely going to be your first people that come in on something. And then you take that and you build that. And then an angel, business angel, someone that maybe they don't know you, and they likely don't know you up front, but they'll start to see good things, and your ability to attract capital is largely dependent on this snowball effect that you're going to get going.
David, Christina Key shared a great story last week. She's the one who launched a hedge fund that trades at $7 billion a day today from her dorm at MIT.
She's super impressive. Yeah.
Yeah. So she tells the story about, no's, like there's no tomorrow, no's. For endless no's, lost every pitch event, never got anything at a pitch event, never even acknowledged. But at one pitch event, the organizer said, hey, I think you need to talk to this guy over here. And she walked her over to the gentleman, and he said, I heard your pitch. Let's go have some coffee. They sat down. He had launched a hedge fund when he knew nothing. And he, right there, after they talked for a little while, he wrote her a check for $100,000. And she was so young. She's like, what do I do with this? It's a funny story, but folks,
that's a pretty good coffee. Yeah.
Yeah. She had a mountain of no's. And so that's how it can break for you, quickly, easily, or forever in getting no's. Andy Jack asked a great question. When is a good time to ask a current investor to actually join the startup's board of advisors? I'm really curious about your take on this, because I have my own opinion. So I'm excited to hear yours, David.
Yeah, and let's see where we differ in terms of some of the experiences. Because I always find these conversations are good when we can draw from different examples. And so in mine and of the startups that I've seen, there's sort of a pyramid of investors and a pyramid of advisors. And so from the advisor standpoint, even before you go out and talk to your first investor, I tend to throw advisors into like one of three categories. And so the first one is the advisor someone who's a doer and knows how to do something that you don't know how to do, right? And so an example might be you know the industry and you totally know the customer base, but you don't have the technical background, right? And so it would be great to your team to add an advisor that has a technical background, right? And so they can do something that you don't do. So that's type one. Type two is someone who is probably more of the connector. And so maybe they know the industry. They are the ones that have this great Rolodex where they can connect you with a potential partner, a customer, et cetera. And so those industry connectors tend to be really good advisors as well. There's a third one, which not people don't always get, but it's a handy one to have, which I call like the celebrity advisor. So it might be some well-known person in the industry where he or she never even has to pick up the phone, right? They don't have to tell you anything, they don't have to do anything, but just the sheer fact of credibility of having this person on your formal board of advisors is enough of okay, I should pay attention to it. And so this has to do with optics, but that's also another type of advisor. And so those are your three types of advisors that are formally part. But every single startup, and as you know this, has this big group of fans that never kind of graduate to the stage where they actually get some sort of equity in the company. And so don't discount the fact that there's a whole group of people to tap into that, are fans of what you're doing. They'll pick up a phone call. You're probably not relying on them, every month sort of thing, but there's this very big network, and that is your pool that you should build up. And most of the startups I work with, I'm actually in that pool where I don't have any formal relationship with them, but I'm a fan of what they're doing. And so,
that's a tricky path to go on, because I'm a fan of bringing on a proper board of advisors when you're raising Series A. But in my opinion, humble as it is, when you're doing seed, pre-seed, this early stage, you need to be completely focused on getting this company, your business up and it's walking, okay? This is no time to be talking equity. This is no time to be having monthly meetings with advisors. You are full on. Your advisors need to be people who are there saying, how can we help? Who do you need to meet? How can I cheer you on, to make your life easier? Then when you're ready to go and raise the Series A, then you can talk, serious equity for that role as an advisor, provided they are adding value to your bottom line. So I love your advice that you just had there, David, is, having, a group of fans and someone, of your caliber, et cetera, who are there, who may have, an instrument of equity into the company, but they put money in. Don't be giving away, your equity in your business because someone is excited about what you're doing and passionate, and they're an advisor. I went through the .com world. I had a .com 98 to the end of 00. And I spent a lot of time negotiating with employees on their stock options, I'll tell you that. But, that's not where you want to give out. So I love your advice. These are a team of people. You can put them up on a slide and people go, oh, wow.
Yes, exactly.
They've surrounded themselves with these advisors that are there to cheer them on and help them. That's wonderful. It gives credibility to you, the founder, and it shows that you have found, aligned members to dive in and help you out. And to go back to what you said earlier, yes, AJ, very true. Untargeted conversations will waste so much of your time when you're fishing with a really, really wide net. And hey, Oliver, another Boston fave. How are you? Oliver was on the show a few weeks ago, David, and how he supports our Latino founders something.
Yes, Oliver's great.
He's just terrific. So yes, grateful to have David sharing his wisdom. So thank you for that, David. I also want to bring up a slide here that we were also talking about, which is so I can solidify and cement in founders' heads. Don't ask for money. Who else should I talk to? Who would be helpful? I'm not ready to raise. Talk a little bit more about this. I'm sorry to bring it up at the time, but I just want to nail it down for founders.
Yeah. And I also just would caveat this with this is one way to look at the world. I know plenty of very successful founders that don't actually like this step, right? And we can talk about why it works, like a different strategy works better for them. But this is the playing off of the psychology piece to it. And so before you go and do your formal raise, one very effective thing to do during the socialization phase, this, step 3 of 5, is around using some of these phrases, right? Where you're basically you're testing the concept, you're trying to work your way in. And on the bottom are the 3 kind of key reasons why. So one is it really improves your hit ratio. So you may imagine if you talk to an investor, very first time you meet the person, you do your pitch, and at the end of 25 minutes, you go for the ask. It's like, all right, will you invest $25,000 in this? And the likelihood is just pretty low, right? You could get really lucky, as Christina did with that first investor, but you're gonna have a lot of those conversations, right? And so that's one reason to do it. Now, if you ask something different, which is, I'm not quite ready to raise, who else is, any feedback on the concept? Do you have a customer that I could talk to? Your hit ratio, your conversion rate goes from, I'll just call it 5% to probably 30%, right? So the person will lean in. And so that's one key reason.
I love
the
that.
second one on that was around the making sure that when you do that, the big thing is that it creates some good data points for the investor. So you may imagine we had coffee. You asked me for, hey, is there someone I could talk to that can help flesh out the product? I'm like, cool. 3 weeks later, you come back to me and shoot me an email or a text or whatever and say, I chatted with that person. It was either good or bad, right? It kind of almost doesn't matter whether it is good or bad, but showing follow through, and it gives the investor the sense of a trend line. Like when you say you're going to do something, you'll do it. And so suddenly 3 weeks later, I have these 2 data points, or coffee and the second data point. And now I can see that trajectory, right? And so that's another reason to do it. And then the third one is because the venture and angel and investor community is really small. The thing you don't want to do is to prematurely start the clock. So I can't tell you the number of times I've talked to an investor or a founder where they've heard the concept. And so that person had been talking about it, basically socializing, but asking. But if you don't know as an investor and you think that person's been trying to raise for a year plus, you're like, well, they should stop, right? Like it's, this is not the thing that is working. And so you don't want to you want to control the clock, control the shot clock.
I love that. Yeah. Don't let somebody else set your time for you. Wow. Hey, Nikhil from London, founder of Vast Minds, David. It's a telemedicine company that's using AI to do diagnostic
so needed.
Anywhere. Yeah, anywhere in the world. And he's also rocking it and preparing it for the space travel industry, because you have to monitor
this world, right?
Yeah, out of this world, right? Thanks for swinging by. Yes. Amazing advice. And we're going to continue. So during a pandemic versus really flush years, what do we do? What do we need to know about valuation? Because there's so many different ways of, figuring out, folks, calculating valuation of your business. But does it become tighter during a crisis, a pandemic, and an economic collapse, David? What happens?
Yeah, it sure does, right? Like we can sugarcoat it as much as we want, but for sure, there's a hit on valuation, and it could be anywhere between, mild to, I've heard cases of 20, 30% kind of thing. And so I think, all things being equal, both what you're doing as a founder and also the investment landscape, there's going to be a little bit of a shock on the supply and demand. And so what corrects for that? Price. And so valuation is about price. And so you're going to get a little bit of a hit in most cases. Now, it could be different if you're in a space like Tequila's around telemedicine and things are up and to the right. Maybe not, right? Maybe you're going to be where you'd normally be, or even a little higher. And so I think that's just something that's a realistic thing. I think what you want to do is you want to bake in for the fact that the runway will likely need to be a little bit longer. And so you just got to plan for that when you run your experiments and you figure out whatever else you need to do as part of that round.
That's really good advice, folks. You've got to know what your runway is, and the longer runway you have, the better chances you have of taking off. But also, it's a good time if you're really running up against a head wall of valuation challenges, and you really don't want to be giving up that much equity of your business for that amount of money. Get the customers. Find a way to get the money in through bootstrapping, through customers. Maybe family and friends will come in at a valuation that works for you because they know that they're supporting, or maybe you need to go to regulation, crowdfunding. Maybe that's the way you need to go. But and find other creative ways to make that happen for the business. I know we've got another really great slide of yours here, which I love, love, love. Don't share everything at once. I mean, I am a huge fan of this, David. For so many reasons.
the analogy, I guess this show is going to be full of analogy. I actually was thinking about that runway and takeoff one, Andy, that you just shared, and it was super logical, but I've never actually connected those two things. So it makes sense, right? You got a runway, and you're waiting for a startup to take off, and it's I'm going to have to steal that from you, because that's
good.
So this one is more about like in the early days where you're dating. I just see this mistake every now and then, which is an early stage founder will show up and throw everything at someone, and it's just too much, right? And so the main point here is make sure that in terms of collateral or anything that you show externally, that you have this nice ladder of materials, right? From the one sentence, the Mad Libs version, as you showed earlier on, all the way to the super deep. We have 2 hours. I'm really leaning in. I've got a group of other folks that are leaning in, and we're going to go nitty gritty into every single thing. And so that's the detailed set of assumptions, the slide deck, maybe a spreadsheet. And so there's a wide range, and just make sure you know when to pull out the appropriate collateral.
I have a one pager too that I love, and folks just ping me and I'll get it to you. It's in template form. You can put it into Canva if you want, but it really makes you look bona fide. And it has one column.
What a great resource.
Yeah, it's the one column that just who you are, who's part of your team, who's your legal CPA, what are your assets, how much are you looking for, use of that, and just a quick little 3-year projection. Then you can go into a column where you're doing the details, a quick executive summary, a couple of paragraphs, your success formula, things like that, ownership, important things, but it's on one sheet. And it just gives everybody a quick snapshot of your business, formatted as if you were a Fortune 5000 business, and sometimes, you've got to be thinking along those ways as well in how you present yourself. And that's why, David and I are both fans of the lean pitch deck, right, David?
Yes. And it's a really clarifying way to work out some of the noise, right? Because you'll want to, if you're like me, I tend to throw a lot of stuff down on paper, and then suddenly you're like, I've just said the same thing 4 different ways. Right. So stripping away some of that noise lifts the level of signal. That's right.
And what you're doing is you're trying to, I should have you say this, David, because you are the expert. It's really trying
to. That I've just made a lot of mistakes. So
I'll discern, if the investor or the group has an appetite for what you have and what you're bringing to the table. And a lot of times we think that, hey, anybody who's dated, you meet someone like, oh, this could be the one. No, this could be the one. It's the same thing with our angel investors. Here's a question from Nikhil. David, how much runway do you think you should have left before approaching investors? Typically, we think we should have about 12 months left before our first approach, but we may be wrong.
Yeah, that's a good one. I typically give people the guidance of 18, so closer to 18. It all depends on your stage, and these are not hard and fast rules, right? Because you can alter things a little bit. What I find is like anything shorter than 12 months, you're just right back at it, right? Because just there's the cycle time of figuring out who the right investors are, making the socialization phase, doing the outreach, closing. And so if you need 6 months, you're doing this all continuously. And so like less than 12 months is not good. And I think depending on the business that you're in and knowing now just a little bit about what you're doing, I do think you can keep it to the kind of the 12 to 18 month side. That if you raise too much, obviously it's the whole dilution thing, and you don't necessarily need it. I do know some other founders that care a little less about that, and this is the whole fear versus greed thing, where the fear of running out of money is stronger and the risk of running out of money is stronger, that they have consciously made the trade-off, and it's a perfectly fine trade-off of let's raise more when we can. And there's a whole school of thought around that, and it's all great. Take some hit in terms of dilution, and we're fine with that, but then that optimizes for the long term. So you can make it even longer. I not recently, but I had invested in a startup with some serial founders a while ago. They have a 10-year runway. Like, it's insane, right?
Wow. Well, and this brings up this side.
It's an edge case.
Yes. how much to raise, basic financial model of cost. I mean, this is another wonderful, wonderful slide, David.
Yeah, and there's nothing sort of too complicated about this, right? You
Yep.
could probably do this in half an hour, where you
Yeah.
throw down a bunch of columns, and
Yep.
it's just a sense of where you'll be. And so just make sure you have do that homework
All
before.
right. And then for our first-time founders who are trying to just really understand this, and they're still interviewing their attorneys and they're trying to figure it all out, I want to bring up a really important slide, which is the structure. This is, again, from a slide deck that David uses when he shares his brilliance with folks, and understanding the difference between equity and debt. And so I'm just going to let that hang there. Any thoughts that you have, David, on that?
Yeah, I think the main one is that there's generally these two instruments or classes of instruments, and left equity is generally expensive, right? And so my take is, only price around when you generally know where you need to be. And so I think some early stage startups, you can do the debt route. And so the equity side is, you'll hear terms like, price round. You're essentially selling a portion of your company. If you watch Shark Tank, that's essentially most of the deals, right? There's buying 10% for, 100,000, so it's $1 million valuation. So that's that side. The other side around debt, it can be a convertible note, which then turns in equity sometime in the future. The Valley has created these great instruments called SAFEs, right? Simple Agreement for Future Equity, and that's essentially like an IOU. And on that side, they tend to be a lot cheaper in the early days. And so the pros and cons are, you spend a lot less with debt instruments at the beginning, but then you're kicking the decision making down the road, right? And so there's a little bit of a trade-off. And at the end of the day, some investors will only do one versus the other, but a good attorney will help you figure out what makes the most sense.
It's wonderful. And again, a lot of first-time founders here with Startup Life. So that was really, really helpful. I love that slide. AJ's asking, if you haven't received a hard no yet from the investor, how many touch points are considered too much to the point of being labeled a stalker? I was just going to ask,
here we go.
how do we do the follow-up, AJ? So thank you. Your question is so perfect.
Yeah.
That's what I hear all the time. Yeah.
I think the main thing you want to do in that case is to press with the investor as to whether or not there's some piece of data that is unknown, and so that's risk, right? Like some piece of data that is unknown at the particular time that would tip it one direction or the other. And so the dynamic that AJ just mentioned is true all the time, right? Because investors, and I'm in that camp, well, we want to keep our options open. So it's in our best economic interest to wait it out when we can, unless you're creating this velocity and this FOMO where if I'm going to miss the train, then I want to jump on the train kind of thing. But barring that sort of dynamic, then push back on an investor to really dig in as to what the driver is. And it could be something as stark as there's a fundamental disagreement of like where the market's going to go, right? And so you're not going to convince them in a short period of time, right? If they think AI is going to take over the world, and you're this thing that's like completely zero, and you're banking on a different trend, then there's not a lot of stuff that you can say back and forth to change that person's mind. But if the no is because what you might hear is, oh, we're too early. Okay, but tell me more. Why is it too early? It's like, I don't think this particular conversion rate in this market will hold up because I've got 3 other data points that say something different. And so if you can show how you're different and prove it and give some data behind that, then that no will turn into a yes, right? But like, it's a matter of trying to uncover that with an investor.
Brilliant. Thank you, AJ, for asking that question. It was next on my list of questions for David. Excuse me. So David, during this time, when founders are thinking, and listen, negative thoughts can happen. Why should I bother? Is there money out there? What advice can you give them regarding, don't let the pandemic, don't let the circumstances around you stop you from finding folks who have funds that could really benefit you and your business?
Yeah, there's definitely money that's out there. So I'll just kind of open it with that. One of those links that you had shared up front was it was like 2 different resources. So one was around a list of investors that have been active during this time period. Perfect. And so if you click through that, it's a great doc that DocSend put together. And so I find it to be a really valuable resource. And the other was something that was a little bit more crowdsourced, and it was a list of investors that were actively taking meetings. And so it's a little bit different, but it sort of helps you triangulate upon like who's sort of sitting on the side and sort of watching where the market's going versus who's digging in deep right now. And then the other thing to keep in mind is that, investors, much like everyone else, they have a job to do, right? They were in charge, especially professional investors. Limited partners invest in what they're doing, and they have to deploy the capital, right? And so they can't just sit on their sides and we're not taking any meetings. And so keep that in mind, that the investor needs the entrepreneur, just as much as you need them. And so, although it seems like it's a one-way street frequently, remember that it's not. It's this whole ecosystem, and both sides need each other to do all the good stuff that we all want to do.
Oh, that's a quote I'm going to take and bundle up for sure, David. We're going to do one more question here with Nikhil. David, really interesting point with having a debt structure at early stage for a convertible note. Do these usually convert to equity at a sizable discount to the prevailing market price? Oh, wow. Way to pick David's brain, Nikhil.
Yeah, I've seen plenty of discounts. They seem to range in the 10 to, I've seen a bunch of 10s, a number at the 15s. 20 seems to be, at least in the early stage, sort of a standard benchmark. I've seen 25s as well. And so I think if with any one of those, the back and forth that you're having with the investor is a perfectly valid discussion, right? Like where you think that discount should be. And of course, there's some nuances as to when the next round is going to be, how close you are. And so, keep that in mind. I think if it was a zero discount, then you may get a little, sort of like, well, what's, why am I doing it now kind of thing. I think anything more than 25 just seems sort of egregious unless there's some extenuating circumstance that is creating that dynamic. And so that's generally the range that I see.
And Nikhil, I got to tell you, those watching the replay are going to say, yes, I'm so glad that guy asked that question. That's what I was thinking. That's the beauty of showing up live, folks. You can ask the questions, but you can also throw them in the comment threads and we'll get back to you. David, what do you love best about working with founders and mentoring? Because you're not just investing, you're also mentoring founders every day.
Yeah, I think my biggest one is in working with a founder, you get to almost experience a little bit of what they're working on, right? And so, it might be someone that's reinventing digital health, or it could be someone that's building the next new consumer app that helps you engage with people differently. And so, whatever that thing is. But, from my standpoint, it's such a cool thing to be able to work with that founder and help in some way, right? So sometimes it's I know something that maybe they don't know and I'm able to help out. Sometimes it's the reverse, very frequently, where they know something where I'm actually learning from them and keeping plugged into a market. And then other cases, it's in an industry where I might have some way to help where I'm either connected or I'm able to move the ball forward faster. And so those are all great things. And it feels like from an investor advisor standpoint, these are, it's more than paying it forward. It's just simply, it's putting your mind and your resources and the stuff that you've built up over years to good use. And especially if you could do it with someone that's got the energy and the desire and the determination to do something, then absolutely, like, why not?
Yeah, and such great advice and great thoughts too, and remember this, founders, when you're pitching to angel investors, they're called angel investors for a reason. And it's your job to find the ones that are aligned for your business. Don't take bad money, okay? Don't take misaligned money. Take money from folks who love you and love what you're doing. You just heard David say, just the ability to help move the ball forward, to help do this and all these things. It really lights an angel's heart up, and that's what you love. And that's why we love working with angels and having really great angel investors in. Can you mention, before we wrap things up, one thing that's important about the founder? Because I think when you're in pre-seed, early stage investing, talk just a little bit about why the founder is, at the end of the day, who you might be investing in.
Yeah, it's an old adage, but it really is true. Right? When I look at what kind of companies to invest in, they need to be solving a problem, right? So there's an opportunity there. They need to have some sort of product solution that is differentiated in some sense, and then none of that matters unless you've got the people behind it. And so this whole team is everything. It's absolutely true. If the founder can't attract other good people to join the journey, then as good of an idea as you have, it's going to go nowhere. And so for every single founder that's out there, the ability for you to take that idea and run with it and get great people to join you on your journey, that's arguably the most important thing that you need to do.
It's your most important role. David, thank you so much for joining me on the Startup Life Show. This video, I'm going to tell you, is going to be a very popular replay for many folks because you took us through the journey. And, a lot of David's advice today, folks, is relevant whether we're in a pandemic or not. It's so important. And I just love the slides that we got to share with folks and everything that you brought in your wisdom. Thank you so, so very much for joining me. And I am going to now close everything out, folks, and let you know what's happening next. First of all, you know how much I just adore all of you and so grateful for your tuning in and carving out time. David shared so much advice with us today that I know that you will sit with and replay and take it in, because this journey is so important. This initial stage, as we talked about with that runway, is so important for you and your business. If you have any questions for David or me, pop them into the comment threads, shoot us an email, and we'll get right back to you. And for those of you watching the replay, remember, hit that subscribe button, click the like. So important. Thank you very much for that. And I want to remind everybody, you do not need to struggle alone right now. Raising a business is not easy. I've raised 4 myself, and you've got to have that extra sort of mentorship to help you get through those tough days. I do pitch deck reviews, strategy sessions, on-demand founder coaching. And when I say on-demand, I have clients that call me and we have 5-minute conversations. I charge by the minute. What can I tell you? It works. You're a busy founder. You know that can help you with your business and help move forward. So please reach out to me. Schedule a 15-minute conversation. Right here, you can just, that's my meetup group. Here's the 15-minute conversation. And we can kick the tires, see if we're aligned, okay? I also want to share with you next Friday's Startup Founder. Okay, come on. We're going to need to go and talk about dolls. Woodline Parame is an amazing founder who is helping little girls love themselves inside and out. She's got dolls of every hue, and she is originally from Haiti, and she's going to be sharing her startup story. And yes, we're going to be playing with dolls for sure, and learning more about how she serves the world. You can stay in touch and receive alerts for all my shows right here by joining my meetup group. And I post there whenever I'm having a new show. You can always find me here on Tuesdays and Fridays, usually at 1 p.m. EST. I'm so grateful that you tuned in. Thanks, live folks, for all. Oh, hi, Joyce. Good to see you. Thank you for tuning in and bringing all your wonderful questions. It means the world to me. You've got this, okay? Stay strong, stay focused, get out there and socialize, as David said, and connect with others, collaborate. Even though you might be grounded right now, you can still make meaningful connections out there, and you can still raise capital. I really know this to be true, and I believe in you guys. So until next time, mwah, I'll see you, and enjoy raising your business. Cheers, everyone.